Have you spent your entire life building wealth in the United States? Maybe you own a rental property, a successful business, a very large IRA, a solo 401k, investment accounts, and your dream is to retire in France. Here is the question very few Americans ask. What happens to all of that when you pass away? Because if you die while living in France, your estate may suddenly become subject to French inheritance tax rules. And that can come as a huge surprise. Today, I'm going to explain the main tax rules you need to know. But before we talk about taxes, there is one distinction you absolutely need to understand. There are two completely different aspects of inheritance: the civil law aspect and the tax aspect. The civil aspect determines who receives your assets and how your estate is divided. For example, unlike in many US states, French law does not allow to completely disinherit your children, even if you create a specific legal structure designed to bypass this rule. French courts can recharacterize it and apply the French forced heirship rules. If you need advice on that part, you should absolutely speak with a French notary. Today, however, we are focusing on taxes, because this is where many Americans planning to retire in France become confused. Imagine you spent 40 years building your wealth in the United States. You accumulated a sizable investment portfolio, a large IRA, solo 401k, real estate properties, and maybe even a successful business. Then you retire to France, enjoy your life there for several years, and eventually pass away. Many people assume those assets will simply remain under US inheritance tax rules. That assumption is often wrong. If when you die, you are considered a French tax resident, France generally acquires the primary right to tax your estate under French inheritance tax rules. And this is not something you can choose before moving. It is not an election you make. Your tax position depends primarily on where you are tax resident at the date of death. If you are unsure about the French tax residency rules, I've made a separate video that you can find in the description. Now, you've probably heard someone say on the internet, you only become subject to French inheritance tax after living in France for 6 out of the last 10 years. Be careful, that rule does exist, but this rule only applies when there is no inheritance tax treaty between France and your country. And as we are speaking about the US, there is such a treaty between France and the US. So this rule, wrong. As a result, in most situations, the country where you are tax resident when you die, in our example, France, has the primary taxing rights. There are exceptions, especially if you only recently moved to France. But for most retirees who genuinely relocate, France becomes the primary taxing jurisdiction. Now, let's clarify how the French-US inheritance tax treaty actually works. If you die as a French tax resident, France generally has the primary right to tax your estate. However, because you remain a US citizen, you may also be subject to US estate tax rules. The United States is one of the very few countries in the world that continues taxing its citizens regardless of where they live. Fortunately, this doesn't necessarily mean you will pay taxes twice. The treaty contains tax credit mechanisms designed to eliminate double taxation, if so. So, while both countries may have taxing rights, in practice, you generally shouldn't end up paying the same tax twice. Let's take the typical case. You are a US citizen, you retire in France. You become a French tax resident and you pass away in France. How are your assets taxed? The US-France treaty says the following. First, the real estate is generally taxed where it is located. A property in France is taxable in France. A property in the United States is generally taxable in the United States. Second, assets connected to a business are generally taxable where that business has permanent establishment or a fixed place of business. Third, tangible personal property such as furniture or artwork is generally taxed where the property is physically located. Finally, assets such as stocks, bank accounts, cash, patents, intangible assets, trusts fall within French taxation. One of the biggest differences between France and the US concerns the amount that can pass tax-free. In the US, the federal estate tax exemption is currently around $15 million. In addition, some states ask for inheritance taxes, often with much lower exemptions, sometimes around $5 million, depending on the state. But France works very differently. In France, inheritance tax starts from the first euro, after the applicable allowances, if exists. For children, each child benefits from 100,000 euros allowance. Only the amount exceeding that allowance is taxed. I just put the current inheritance tax bracket on the screen, the one for 2026, so that you can see that it goes from 5% to 45%. As you can see, the difference between the US and French system is significant. So if you're planning to retire in France after building your wealth in the United States, do not assume your estate will simply follow US rules. I mean, in terms of taxation, the civil law rules and the tax rules are two completely different topics. Understanding both before you move can save your family from very costly mistakes. And if you would like to better understand French tax residency, make sure to watch the dedicated videos below because everything starts here.